Okay, Robert Shiller, who is the co-creator of the Case-Shiller Home Price Index, actually had a few words to say about the status of today's housing market and where it's headed in the future. A lot of stuff to talk about, a lot of stuff to unpack. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is the 11th of August. The week is almost over. Kids are back in school down here in my area. Hope you're doing well. Randy Patrick here. What am I doing? I'm putting the realism back into real estate. There you go. This video is brought to you by our friends from where? Foreclosure.com. You know we're talking about foreclosures all the time now. You want to find out about foreclosures, what's happening in your backyard, go to gethousingdata.com. That's gethousingdata.com. Check out what's happening with the distressed property market. Okay, so we'll get to Shiller in a second here. So this is an article, obviously, I put up on the screen here. It basically comes down to, hey, you know, number of active listings are jumping 31% versus this time last year. This is based on a Bloomberg report citing information from Realtor.com, which is fine. Obviously, you know, the sharp slowdown in activity suggests that the Federal Reserve's effort to curb inflation through rate hikes have had a dramatic effect on the pandemic housing frenzy. Would-be buyers have been sidelined. Sellers consequently have responded by trimming prices to compete. So yes, we're seeing more inventory, 31% increase year over year. We're now seeing sellers, and we have seen sellers drop prices, trim prices, because what they're needing to do is to make up that difference from higher interest rates means less borrowing and buying power for a buyer, which means sellers have to accommodate that and drive their price points down. So with inventories increasing, buyers will have more negotiating power. 2 years of a market heavily tipped in favor of sellers. It appears to be in the rearview mirror. So now everyone's kind of saying we're shifting. Like, this shift is not a transitory thing or a short-term thing. The shift is kind of here to stay, and we've already peaked. We're coming down, starting down on the other side of the mountain right now. That's pretty obvious. So interesting enough, home builders have found themselves stuck with too many houses as demand has cooled. There's certainly a bit of pressure on us, says a realtor who deals in new homes. Builders have got to hit goals and make profit, and they don't like inventory sitting around on the ground. And an abrupt halt to pandemic housing boom has left builders that started construction months ago scrambling to adapt. Yes, it's pretty difficult. And this is very interesting. This last paragraph here is in June, there were 824,000 single-family homes under construction in the U.S., more than at any time since October 2006. So I know, based on the last housing crisis, which I was fully aware of, fully invested in, and fully participating in last time around, that there were tons of builders that just were going gangbusters, right? They were working the wave, and they got caught. I remember in our area we had Lennar as a builder who basically were selling properties. Suddenly they hit the wall. They started dropping properties, and they still had phases of dropping property prices. They still had phases of phase 2 and phase 3 going. So what they were doing was they were discounting whatever was left in phase 1, and then trying to get buyers to buy and commit. Then when that was done, they'd actually bring out phase 2 at a lower price point than phase 1. So made for a very unhappy home buyers. Also, people got caught with respect to builders dropping prices and immediately putting their brand new closing that they may have jumped into 2 months ago immediately underwater. So unsold inventory has ballooned partially as a result of supply chain disruptions and labor constraints. But again, the point here is that just like back in 2006, we're at a huge number of unsold inventory or homes in construction, which is precursor to the housing market kind of coming to a little bit of a crash here. So this is where Robert Shiller chimes in. So Shiller, who is an economist, and I said he's the co-creator of the Case-Shiller, I think it's called the S&P CoreLogic Case-Shiller National Home Price Index. So obviously, as we know, because I talk about this every month, the index has 3 indices, a national one, a 10-city composite, and a 20-city composite. So basically, according to him, who predicted the 2008 housing bubble, the U.S. housing market's headed for trouble. So I have to make a comment here, is that he doesn't speak very often. So when he does speak, you kind of have to listen to how he speaks and how he's quoted or what he says, because I have noticed over the past few years he's been very coy as to what he says and how he says it. And he certainly is concerned not to say too much because we all know that all heck would break loose if that was the case. So what his quote is here is saying home prices haven't fallen since the 2007, 2009 recession. Right now, things look almost as bad. Existing home sales are down. Permits are down. A lot of signs that we'll see something. It may not be catastrophic, but it's time to consider that. So basically, again, he's not going to come out and call it like it really is because I don't think he can. And I think that, a lot of people would be very upset if he said, yep, we're having a housing crash. Get ready, folks, because then we'd see builder stock prices further plummet. We'd see lots of other issues going on. So he's not going to say it. So you have to kind of, listen to what I call it Shiller speak, read between the lines here. He added that a drop on home prices is more likely than not, which is obvious. The Chicago Mercantile Exchange has a future market for home prices. That's in backwardation now. Home prices are expected to fall by something a little over 10% by 2024, 2025. That's a good estimate. The risks are heightened right now for buying a house. Now, again, going to Shiller speak, what he's saying is that, yep, I see things falling in the next little while. Over the 10%, that's a good conservative estimate. So, he said it's a good estimate, which kind of means it's going to be more than 10% in Shiller speak. The risks are heightened right now for buying a house. So that's what he's saying, don't buy a house right now. If you're buying at still what is inflated prices, if you wait a couple years or at least a year, you're going to see some changes in price point and values. That's your time. So as I said, Shiller speak, you listen to what he says. What he says is few and far between, timing and words. And then when he does say it, you got to pick and choose how he's saying things to get the play as to what's going to happen. So basically, he's calling the housing crash, but in the conservative tone, he's saying, headed for trouble. Things look almost as bad. Home prices are most likely to drop than not. 10% is a good estimate. The risks are heightened now for buying a house. So that's his quotes. You read into that what you will. I know that from what we've seen in the past with him, he needs to say things conservatively, and we know that it'll be worse than what he's saying right here. So simple as that. All right, guys, listen. If you're not a subscriber to my channel and you'd appreciate the information I produce on a weekly basis, do me a favor, hit that subscribe button. I'd really appreciate that. Thank you very much. For those of you that are subscribers, please resubscribe if you can and help my channel maintain its position in this competitive environment. To sort of tag into what he's saying here is that, all, as I mentioned last video, all the discussion points are really just based on what? On home values going, more inventory, loan prices or mortgage rates going up. So we're seeing, estimates of correction or crash, numbers, deceleration, home price, appreciation coming down, whatever, values changing just from that alone. There's no mention or no commentary on what happens when the foreclosures come. All right. So just so we're clear here, take a look at the, I guess you could say, the headline here, U.S. foreclosure activity drops 4% in July. All right. Well, if you take a look at it, it says here, default notices, schedules, auctions, or bank repossessions down 4% from a month ago, but up 143% from a year ago. So back to the narrative where we don't want to scare people and let people know that things are going to change. They could have said U.S. foreclosure activity, increases 143% from a year ago, but they chose to go down to say the decrease, it drops. So you see, it's all about positioning, perspective, changing or maintaining the narrative you want to be in. Okay, so yeah, it dropped 4% activity, total activity from June to July. All right, but compared July last year to July this year, it's up 143%. So again, it's all the perspective and how you want to say that. But the point is, foreclosures are up. So Delaware, Illinois, and New Jersey had the highest foreclosure rates. Those are per capita rates. If you want to keep going, Nevada, South Carolina were also in the top 5. Among the metropolitan stat areas with populations greater than 200,000, you had Elkhart, Indiana, Davenport, Iowa, Fayetteville, North Carolina, Cleveland, Atlantic City, who has, they're having an increase in rates. Areas greater than 1 million with the worst foreclosure rates are Cleveland, Ohio, Chicago, Illinois, Las Vegas, Nevada, Riverside, California, and Philadelphia, Pennsylvania. So as I keep on mentioning, whenever we see these statistics, it is the same generic locations that had the same issues last housing crisis that are rearing their ugly heads again. This should come as no surprise to anybody, and this is typical in the larger cities and stuff that's going on in the marketplace here. So foreclosure starts increase monthly in 21 states nationwide. So lenders started the foreclosure process and again, overall foreclosure activity is, repossessions, notice of defaults, stuff like that. But the foreclosure starts, okay, that's the list pendants filing, notice of defaults, whatever. So the lender started the foreclosure process for 21,000 properties in July, down 4% from last month, but up 226% from a year ago. So the increase in foreclosure starts is prevalent. 226% from a year ago. That basically is lenders going, we need to file the notice of default, file the LP list pendants, let's get it going. Okay, we got to catch up here. So it appears that a few states are still catching up on processing foreclosures on loans that were seriously delinquent prior to the pandemic. Basically, we're looking at areas that have the greatest number of starts like New York, Chicago, Illinois, LA, Miami, and Philadelphia. Again, major cities that had major problems from last year. So these are foreclosure starts. So the lender goes, I've had enough. Now is the time where I'm actually going to be, starting the process to obtain that property back for non-payment. So that's what goes on here. So this is the starting point, and it's going to increase. It's going to increase every month as the next couple of years go on, and we're going to see a lot of volume that's happening. Now, I know people who are commenting on my channel are saying, blah, 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 you're talking out your butt again, and this is not going to affect the marketplace. Okay, well, there's two things that are going on here. Okay, the foreclosures are coming. Okay, not every foreclosure manifests overnight and suddenly changes the marketplace. So it does take time to play out. Go back to the last housing crisis. All you have to do is go back in time, the last housing crisis, and see how that played out. Started in 2007 and sort of troughed to 2012. It was a 5-year play to get from starting the foreclosures to low property values, and there still were foreclosures being cleaned up, 13, 14, 15, 16. So this is not just a 1 year, 1 month little play. It usually goes on for quite some time, all right? It's a large adjustment here. So realize that does actually happen. And the fact of the matter is, people say, well, where are these foreclosures? They have to get filed to start the process. So we have the shadow inventory behind the scenes of people not paying their mortgage for various reasons, which is nebulous to us at this point in time. The point is now the lenders are going, we've had enough. We've had the 2 years of eviction and foreclosure moratorium. We've had the forbearances. Now we need to get back to the normal progression of what happens in a everyday real estate market, which is what we're starting with right now. So the foreclosures will manifest. People saying, oh, the Blackstones of the world, America Home for Rent, the big hedge funds are going to pick up all these at the auctions. You're right. They're going to buy a ton of them at the auctions. Where's your opportunity? Your opportunity is to connect with the homeowner to get it pre-auction. The cool thing about foreclosures is we know who they are. We know where they are. We know the address. We know who it is. Thus, we can connect with the homeowner and get them before the auction, help them with their situation, and make some money for ourselves along the way. That's how the market changes. All right. But at this point in time, far too many in shadow inventory, not enough being played out in the marketplace. It's starting, okay? Like it's actually happening now. So everyone, our problem is that everyone wants it to happen now. You want that, 40% off the property today. It's got to take time to get down there, guys. But there are deals all the way down and all the way up as well, too. So please realize that. Foreclosure completion numbers decreased 5% from last month. Completions are sales through the foreclosure auction. So you're going to see some of that drop from time to time. Counter to the national trend, an increase in REOs, which stands for real estate owned, which are bank-owned properties, up in Maryland, Hawaii, North Dakota, Massachusetts, Michigan. States that saw the greatest numbers: Illinois, Pennsylvania, Ohio, Michigan, New York. Obviously, more foreclosures there. Major metros that saw big numbers in REO: Chicago, New York, Philly, Detroit, and Birmingham, Alabama. So, yeah, the stuff's getting foreclosed on, which then the foreclosed on goes, that's not bought by a third-party bidder, goes back to the bank as an asset, and they do with it what they will. All right, but just keep in mind that's how this sort of plays out here, guys. It's actually happening, all right? It just, we see things in real time now with data and information that we're just not patient. I'm the most impatient for this market to have this happen, but it's the way it is, all right? You can't change what's there, but the opportunities are now, you need to go after them, simple as that. So having said that, I've obviously got some things on the go here. I'm looking for real estate agents in Florida. I'm going to open up more metro locations across the country, in specific locations. Interested in doing that. Looking for investor buyers to hop on board. Looking for private lending partners, because there'll be a lot of stuff we're going to be doing. Also, love to create a syndication or an equity type fund to purchase these properties and rent them out. So if anybody has any ideas or would like to participate in that, I'm open for suggestions and partnerships. Reason being, because I know how we're going to get our hands on all this stuff here. So that's a scoop. Now, on the other side, I'm showing you our new logo for our Foreclosure Fortunes product here. Short sale program is being retired. Limited time to get it. It's pretty much over now. Just connect with me if you want to get involved. New foreclosure program replacement includes everything from my previous programs, plus much more. Different modules. It's not bundled. So keep current members will keep what they have, go with the transition, and keep their current benefits. So don't worry here, guys. That's just something to be aware of. So connect with me. That's my real estate number one email there, Randy at luxuryshortsales.com. Connect with me there, guys. And by the way, again, new logo here. So that's Housing Bubble 2.0. That's what we do. Once again, I appreciate the views, likes, comments. Please share the video with your family and friends. I'm trying to keep these videos as short as possible now, even though there's so much to talk about. I'm trying to keep them shorter. I'm trying to take your advice, telling me to keep things shorter. So I'm doing that, guys. It's a lot to get through. I could speak for hours on this, but I'd also like to maybe open up some new stuff in the future where I'm doing YouTube Live for question and answers or other things you guys want to talk about. So if you have ideas or things you want me to touch base on or go deeper on, please email me, let me know, and I can create some specific videos just for that. All right, everybody, appreciate the time. Look forward to speaking with you probably next week. See ya.